Good afternoon, people. Guy Adami and Dan Nathan. Market call, 1 p.m. Eastern time. I don't even know what day it is. I think it's the 23rd of January. January is a blur. This market call brought to you by FactSet, Financial Data and Analytics, Dan, that are powered by Tomorrow. They also happen to be our data provider. In just a few brief minutes, which they typically are, Carter Braxton Worth of Worth Charting. Many things sort of caught me off guard today, the market being one of them. But one of the things that really caught me off guard before we get into the market is the fact that the Dallas Cowboys official Twitter account absolutely threw Dak Prescott under the bus, effectively saying, I'm paraphrasing, but for the 2 interceptions or turnovers from Dak Prescott, named him by name, we would have been competitive in that game yesterday. I don't know what's going on there in Big D, but clearly things are not going well. How are you, Dan?
Yeah, I think there's probably an intern with the last name of Jones who is basically managing that Twitter account there. I know. I actually think they like Dak down there. Yeah, that was listen, good game. Feel for that kicker. I mean, can you imagine being hey, here's the thing. All right, guy, every once in a while when you're trading, investing, your market commentary, all that, sometimes you feel like that kicker. Like this
Hell
is
yeah, I do.
One of those sorts of times, man. And again, you get the yips in the markets every once in a while, don't you?
Got the yips now. I mean, people are, it's interesting. I was reading some of the commentary on Twitter. You guys still can't be bearish, can you? Wedge formation breaking out.
Yeah.
I mean, the market behavior. I mean, if you just look at it through the one metric of the market, things look great. Absolutely. The year is off to a resoundingly strong start without question. But I would remind people, and this is an important week, I think 93 S&P 500 companies report this week. Obviously, I can do that math, a little less than 20%, Dan. See what I did there?
Yep.
So I think we're going to learn a lot more, not necessarily about what the earnings are, but what the commentary is in an environment where seemingly every day we hear about layoffs from pretty significant companies.
Yeah, I mean, listen, again, can the market kind of test your broader thesis about the economy, about the way all of this stuff is kind of coming together? Certainly on a day like today where, you open up, the NASDAQ opened up a little bit. Now I see it up 2.3%. It just keeps getting better by the minute here. Those are the sorts of like environments that are going to question, your counter trend thesis one way or another. And again, I think the narrative, and we talked about this a lot, Guy, late last week, is like the notion that the soft landing is becoming consensus is okay. I mean, people want to be optimistic here, and I get that. We want to be optimistic too. And a lot of people who say sticking your bearish thesis, I think we do a really nice job of trying to point out things if we're bearish that we like on the long side. I mean, that's why we kind of do this every day. But there would take, I don't know. Price movement is not going to change my mind about some of the things that I think that is in store for the economy here. And I'm just curious, is like, at certain point you kind of give up. I will just say this from a trading perspective. I use stops. We talk about a lot of these trade strategies that we employ here, and we talk about mental stops. We talk about using options to define risk. We're going to start doing more as it relates to futures, and you cannot trade index futures if you don't use stops. So you keep testing your thesis and you try to take small losses and not take a lot of big losses, and that's how you kind of stay in the game. But if you're just going to change your thesis every day as the market changes, you're going to have a tough time making money in this market.
You're going to chase, and you're going to wind up, you're going to zig when you should zag. And that strategy, I guess, if you chase performance day to day, it can work for a period of time until it doesn't work. And it's easy to go on air, and I think on the big up days, you come out as a big bull, and on the big down days, you come out as a big bear, and there's no repercussions for that. The hard thing to do in this environment is to not be dogmatic, to be able to remain fluid, but have some underlying principles and things that you're looking at to sort of, I guess, create the thesis that you're trading behind. I mean, the thesis to me, the only thing that's changed, I think, is the fact that the market's higher. Outside of that, nothing has changed about the fundamental reasons we think the market should and inevitably, in my opinion, will go lower.
Yeah, so Mike Wilson, he's the CIO and chief strategist over at Morgan Stanley. He's been on our podcast on the tape a number of times over the last few months, and he's been bearish and right. He doubled down into the end of the year on, or started this year on his bearish thesis, but he did do something really important, and this is mid-October. We talked about it a lot. At the lows, he called for a tactical trading rally, 15%. He got it, and then he turned the other way. He was on Bloomberg this morning, Guy, and he said that, he was being questioned by the two people that are interviewing him. And again, he looks really wrong right now after being really right for a year and going both ways. And he said, our fundamental thesis is still intact. It has not been tested. So here's the question I have for you on a day like today, where the S&P is up 1.5%, the NASDAQ's up 2.25%. And we're just going to have these guys kind of roll through these charts a little bit. Okay. These are 2-year charts. This is the S&P 500. Here we are. We're above that downtrend. We're above that 200-day moving average. We've held that uptrend from October. So are we breaking out here and going to make new highs from that December period, and then the next period would be August? I don't know. I'm going to ask a bunch of rhetorical questions, and I want you to kind of just give me your thoughts. The NASDAQ 100, the NDX, it's been heavier than the S&P. We've been highlighting that for months now. It is above that downtrend, but it has not touched its 200-day moving average. The 10-year U.S. Treasury yield, one of the main reasons why high valuation stocks, went lower last year and considerably lower, and every rally was a sell, and most of them was because rates kept on going higher, Fed funds, and what they were telling you they were going to do with yields. Well, look at that. It's come off. It's bounced off its 200-day. The U.S. dollar, huge headwind, right, for U.S. multinationals, just kept on surging last year, topped out in September, down at from 115 to 102 here, below that uptrend. And then crude oil, last one here, Guy, can't get out of its own way. Yeah, it's rallied a little bit here. Oh, the last point. No, there are two more. I'm sorry about this. The VIX below 20. High yield corporate bond ETF, had a nice run here above its 200-day moving average, closed above it for over a week for the first time in a very long time. All of those things would question your one bearish thesis on equities. Am I correct here? It doesn't really say much about the economy, but it does about views on equity. Talk to me about all of that. Hit it, baby.
Well, all those, let's start from the beginning and go to the S&P 500. We've been we've been focused on this chart for a while for good reason. If we could throw that back up, that downtrend line in place from effectively last December of 22. Yeah, that downtrend's intact, and it appears to be being violated now. To your point, we're a little bit above the 200-day moving average. I guess you get a couple of closes above this downtrend line, and that level from August, which I believe is 4280 or so-ish, that's clearly got a bullseye on it. So could that happen? No question about it. Let's take a look at the NASDAQ, because that obviously is going to look very similar. I've thought for a while 9,800 in the NASDAQ. That hasn't changed, by the way. The only thing different between this chart and the S&P chart is we have not broached the 200-day moving average, and you still have a pretty downwardly sloping 200-day moving average. This looks actually worse than the S&P, but could you take a peek at the August highs? I'm hard-pressed to figure out how we get there. Maybe it's in the form of Microsoft surprising some people to the upside. Maybe it's in the form of Amazon finally getting back, on trajectory higher. Or maybe Apple doesn't guide lower. Apple doesn't say something that disappoints the market. But again, I still think we're in a pretty significant downtrend. Next one, let's take a look at this as well. Yields. Well, we stopped at the 200-day moving average, which is still upwardly sloping. I think a lot of this rally has been predicated on 10-year yields going lower, and I understand that. I just don't think yields going lower is the panacea that everybody seems to believe they are. And if rates have bottomed here and start going higher, well, it stands to reason that if rates going lower is bullish, rates going higher, or at least slowing down to the downside, should be bearish, I guess, and we'll see how that plays out. Let's take a look at the next one. Again, U.S. dollar. This is the one that's, I think, the most interesting. Well, they're all interesting, but the steep decline in the dollar that, by the way, you were talking about in the fall is important. It's important because the headwinds that a stronger dollar provided for these multinationals is clearly abated. And if nothing else, that headwind is no longer there. And for some companies, it might be a tailwind. The question is, are we at this level of support? And will we just do a back and fill to the upside where we test to take a look at the 200-day moving average? So my sense is if rates start going back higher from here, the dollar will follow as well. I think you mentioned oil. Can't really figure oil out right now, to be honest with you. If you look at some of the underlying equities, they're all doing very well. Obviously, the broader market has as well. OIH back above 320. It's all looking good. It feels as though crude wants to party, as you say. And although the 200-day is sloping lower, a test of that 200-day is not out of the question. I think the last time we saw that was probably back in August. So it's rational to be bullish, I guess, given everything you just threw at me without question. And at a certain point, price is going to dictate a lot of the action, because if these things continue to get away from people, there will be a chase early in the year. I just don't think, again, my opinion, the fundamentals do not back up these moves.
Yeah, that was awesome, guy. Way to
Well, I try to pay
hit on it.
attention. Cheapest thing you can do.
Yeah, that's a matter of fact. The other thing is, and we haven't talked a ton about this, like the whole idea about China reopening, I think that has been a big part of this, story over the last few weeks or so, and kind of helped put a bottom in some of those things got really killed. And then when you think about just this kind of, balance to a slowing Europe or a slowing US, the slack that's going to pick up. I'll just say this though, and it's Chinese New Year, so Happy New Year to all of our.
Fong Choi. I
Yes.
said that pretty well, by the way.
Absolutely.
Year of the rabbit.
Yeah. And last night we had a little group text, you, myself, and Melissa Lee, our illustrious hosts of CNBC's Fast Money. And did you notice I sent a picture of my dim sum? I was celebrating yesterday.
You're allowed to do. Don't people get arrested for doing that?
It was dumplings, dude.
Oh, I don't know. I mean, I've seen that, like that guy, the governor of New York guy, or one of those. Sorry.
Yeah. Fair enough. But to me, a big concern is just raging COVID. We have no data on it in China. And, with the spread of people and the movement, for Chinese New Year, might that be something that causes a slowdown? Maybe it's just a near-term blip. Who knows? You're a seller of that theory. I'm just saying, again, it's been a bit of a mess. We don't know much about it, but, who knows if they export some of that outside of the globe here. And again, who knows? I mean, I just think a lot of this is kind of pinned on the hopes of the Chinese reopening. So you're not a buyer of that, huh, guy?
No, I think it appears as though the Chinese have basically thrown caution to the wind at this point, and I'm not certain you can put that genie back in the bottle. And I think I think basically what they're saying now is let's see how the chips fall, and whatever happens at this point happens. So I don't think there's going to be start, another stop on the Chinese front. I just don't think they can do it. So I think that die has been cast. The one thing that we didn't talk about yet, that maybe it'll come up with Carter, I'm sure it will. I think also people get all geeked up when they see activists get involved in names. Obviously, Elliott Capital and Salesforce, I think, got people all jazzed up. And, I understand, and people want to be optimistic. I get that as well. I just don't see, again, when you listen to Mike Wilson and listen to some of the other people that we cite from time to time, these upward moves notwithstanding, nothing has changed but price.
Yeah, well, I'll just say this, and we mentioned a lot of market call here. So, there are two occurrences, like two things that I think a lot of market participants get really focused on, monthly, or there's 10 FOMC meetings a year. And then there's obviously quarterly earnings, in the fourth month, in the, the month after the quarter ends. And we see this. So over the last year, we saw that move after the March Fed cut. It was the first cut since 2018. This was in 2022. We saw an epic rally into earnings, and I think that a lot of it had to do with expectations in and around earnings. We saw that fail. We saw a new low made. Same thing in mid-June around a Fed meeting into Q2 earnings, right? We saw an epic rally. We saw that fail. Then we saw it again in October and December. That failed. We did not make a new low. Here we are. We're doing the same thing. We have a Fed 1 meeting. The consensus seems very clear. CME Fed Watch tool, 25 basis points is a near certainty. And then the idea, now people are talking about when does the Fed start cutting? We've seen some of this Fed speak that they're cautiously optimistic now about a soft landing. So all this stuff is starting to become consensus here. And I guess my point is like, maybe they keep running them. Maybe we get like a 10 to 15% rally, off of the lows. But at some point, I'm just hard pressed to think that, especially with a lot of investors kind of probably out in front of their skis, if we do see economic conditions continue to stay tight, guy, at some point, the weight of that without unemployment ticking up is really going to weigh on S&P earnings. And we're going to have the realization that consensus of a 225 number for 2023 is probably too high. And that's probably when we get the retest. Talk to me about that.
Still too high. Absolutely. What people seem to want to look past is the fact that I don't think we've felt the effect of the Fed's tightening cycle in terms of earnings. I think there's a lag effect that we're going to just start seeing now. And if you really look, you're seeing it in the form of these announcements about layoffs. Without question, that's part of it. And I think it's just a matter of time before you see it in earnings and subsequently earnings forecasts going forward. And again, it comes down to what type of environment we are. And I'll say this, the higher asset prices go, I think the more difficult the Fed's job becomes, which is going to be the more earnest they're going to be in their want to continue to combat. And for the life of me, I can't foresee an environment where the Fed cuts in the back half of this year. But then if you do see that, you have to ask yourself, what's the backdrop that gets them to do something like that? And I mentioned this on an earlier show that we did. You have to wonder when a company like Microsoft decides to do rounds of layoffs. I mean, they don't do that willy-nilly. They do that understanding that they see something, not for a quarter or two, but they're obviously seeing something out into the future, understanding that, they're not going to just start hiring people back 2 months from now. Just not how it works. I mean, these cycles tend to be long. I guess my long-winded point is I don't think we have felt the full effects of the Fed's tightening cycle. I think we're starting to see it now. I don't think the market has reacted to it yet.
All right, fair enough. Just a little housekeeping note.
I like housekeeping.
Before we get to Carter Braxton.
I'm a good housekeeper, by the way.
Many of you know that we are now just streaming this on YouTube. We're focused on this YouTube channel, and it's been great. We really like all the comments, so I got to give a shout-out to some of you guys that are always in here. Chris Sinclair. I'm seeing Griffin Keenan, Jason
Dave
Shapiro,
Wilson, Wallace.
Tony Wallace. We got
Dave Rice.
Gary, Dave Wilson. Listen, guys, and we're going to keep reading these things. Jay Kim, HCP, Eric Clifton. We appreciate all these comments. We're going to try to hit as many of these as possible. Taco Loco, love that one. Harry, Richard, do us a favor, guys. Share this link. So, engage with it, like it, whatever the heck you do. Comment on, on Twitter, all that sort of stuff, because we really want to focus on this. We appreciate you guys being here with us every day. And when we have time, we like to kind of hit some of your questions.
This is a good one. See, and I appreciate that. I'm just reading because we got to get to Carter. Acorn at 111. Put this up, Jacob. I got a kick out of this because this goes under the title of, again, people hear what they want to hear. You guys are full of crap, all capitals. Last week you were Tesla bear, and now you're singing a different tune. I'm not singing any. I don't know really what you're talking. I don't even know if we mentioned. I sold my Tesla last week because of you guys. I left so much money on the table. What's your real agenda? I don't know what to tell you. I mean, we don't really have an agenda. We're trying to help. I mean, I apologize that you sold your Tesla and left tons of money on the table. But, we're also the people that probably 45-50% ago said, you better get out of your Tesla on the way down. So, yeah, Tesla's bounced, I want to say, close to 40% from the lows that it made recently. And I think it's exactly that, a bounce. I mean, we've seen bounces in other stocks as well.
Great point. And I see Jay Rice making the point here is that Carter was bullish on Tesla. Carter came on Fast Money. He put a note out on Worth Charting. He said he'd be a buyer. I mean, listen, I'll just be very clear here. Guy and I are not hedge fund managers. We're not stockbrokers. We're not anything of the like. We do these shows. We talk about them. We trade. We invest on our own. We give you our opinions. We're not making recommendations. That is the value proposition of you being able to listen to our podcast and do that. We want to be as correct as possible.
Oh, I see. Yeah, you're right. And now I'm reading Carter's okay.
Well, but my point is like we want to be as correct as possible because we know a lot of people.
Nobody wants to be wrong.
What we're saying as inputs, just as when I see David Tepper on CNBC or I read some guy interviewed in Barron's or Gal or this and that, whatever. So again, we're sorry that you made a decision to sell your Tesla. But if our commentary over the last year has been, I think, spot on. And, the stock for all of this is just up, 15% on the year versus a NASDAQ that's up 18.5% after it lost $800 billion in market cap off of its highs. So again, thank you for being here. We're sorry that you made a decision about your Tesla. We're just, again, that is what it is. All right, let's bring Carter in here. Carter Braxton Worth of Worth Charting.
There he is.
There he is.
Man,
drab gray. I love it.
Drab gray. I mean, you could give him something else about it.
That's an actual color.
You know what, guys?
There's a little bit of green in it, but
maybe it's bringing out the blues in his eyes here.
My wife would say, and I'm like, I don't know, gray works for me.
All right, Carter, we have an agenda here with you. We got 10 minutes left, okay, in this fine program here. We want to hit a couple things. You know, onward charting, you had a great note on the XLC, excuse me. That's the communications. We're not going to hit that yet. That is primarily made up of Google and Meta and some Netflix and some Disney and some Verizon. You also want to talk about lodging stocks, okay, hotel stocks. You and I kind of hit the Jets last week. Guy obviously was involved in that. I put a bearish bet on the Jets. That is the ETF that tracks the airline. So I'm really interested to hear how you're contrasting those two. Okay. But we were going to hit semis here. There was a couple fundamental upgrades on the street. We're seeing huge move in AMD up 8%. We're seeing NVIDIA, which was not touched, but that is up nearly 7%, up 30% on the year. I want to hit semis first before we get to your XLC, but I also want to get your general take on just kind of the flavor. You know, I don't know if you heard us before, what we're seeing across the stock market. It seems like there is a little exuberance, whether it's rational or irrational. What's your quick take on that? And then let's talk about semis and then some of these communication services names.
Sure. I mean, look, recency, we're all fall prey to it. When the markets, if the market were down exactly the amount that it's up right now, our conversation would differ. We're all always prone to think, oh my God, here it goes. Oh my God, I got to chase it. And then, oh my God, it's falling apart. I got to get out. One of the things I was read something years ago that stuck with me. This portfolio manager, he was writing his quarterly letter, and he said, you know, I'm always finding myself the sentiment of the last author. Meaning, he said, for instance, you pick up Barron's, the first article is really, really bullish. Like, oh my God, I'm so cautious. I got to get on sides here. This is crazy. You know, you go out, fill up your coffee. It's Saturday morning. You read the next article, like, oh my God, it's true. The end of the world. I got to take. Meaning, you read one thing and you feel bullish. You read another thing, you feel bearish. At the end of the day, just stepping back, the S&P right now is exactly where it was in May, and so on a 6, 7, 8 month basis, however you want to measure that, we are unch. We've been a lot lower. We've been higher, that August rally, and we're back to where we were. The question is this. Let's say we do press higher. We breach the downtrend line, well-defined as it is. Is this a setup for something big to the upside? Or is it really just more of the same? We've basically been muddling and we don't really go anywhere. That's my hunch. And I still am in the camp that sideways or down captures 80 to 90% of the odds. And often you do have these things, they're known as bull traps, right? Where you break out to a 52-week high, draw in a lot of money only to reverse. You could very well see where we pierce this line, you get even more bullish sentiment only to crap out, as the expression goes, and fall back into the formation. I just don't see anything that's all that bullish.
I agree with you. And we'll look at semis because one of the most economically sensitive areas or groups, highly cyclical, as we've learned. I mean, the move in semis over the last month and a half has been interesting. We'll look at the SMH card and then we'll look at a couple individual names. But I mean, I guess the question is, what is the market looking at? And maybe they're starting to see some early cycle recoveries in some of these things, or maybe they're saying for some of these stocks, the valuation is too compelling. I would push back and say, valuation might have been compelling, back in the late fall, but it went from very compelling to not nearly as much now. You look at the SMH, which is obviously the ETF that most people look at in terms of the semis. What are your thoughts here? This, to me, at these levels, more pair of twos, maybe getting towards the level where you can short it again.
I mean, the first thing that jumps out, holding aside all the annotations that are there on the screen, it is one heck of a head and shoulders bottom. So the question is it almost too obvious? Everyone's looking at that. Everyone's thinking, oh, it's an epic bottom. What we know is essentially this. The first thing is it's beta. It's declined from its peak, right? The SMH or the SOX index, 48%. Now that compares to 37 for the QQQ and 27% decline for the S&P. And now it's also exhibiting beta on the way up. We're up 40% off the low. So it drops a whole heck of a lot more than the S&P, 48 versus 27, peak to trough. And it's rallied 40% off the low. It's just it's a very dynamic thing. The question is here too, after rallying 40%, you're not free and clear. There's overhead supply. It's got work to do. Today's a big day. My inclination, if I were long SMH, would be to sell calls or to reduce my position, trim, do something.
Yeah, I mean, just like, again, a lot of people don't, care how much you're off a high or this and that, whatever. But I got to tell you, like, I find it astounding if you look at this NVIDIA, and this was the largest market cap name in the space, at least U.S. domiciled here. And Guy has mentioned this on many occasions, that as high as just in December, it was up 75% from its lows, and just in market cap terms, that's pretty astounding, especially when you consider that a lot of its declines in 2022 were really about like multiple compression here. And again, you're probably going to say, if you look at this and you want to be bullish, you could say getting above $200 is an epic bottom, head and shoulders, whatever you want. And from one of the leaders, it just doesn't have any valuation support. So you better see 2023 accelerate pretty meaningfully, which I'm not sure that is what as far as consensus estimates. I mean, right now they have earnings up 30% and sales up, but this thing still trades at 16 times sales. I mean, so that one is pretty astounding. This one though, Carter, AMD, really quickly, can we throw this one up here, because this is below its 200-day, a bit of a mild move off the bottom. It's not that below that downtrend. I mean, is this one, how does this fare versus, like, let's say an NVIDIA? And this one was upgraded at Barclays today.
Right. Well, NVIDIA's further along in its recovery, and so then one either favors the relative strength winner or takes the exact opposite approach, says this is the laggard. And one could say, well, they're not the same kind of semi, Carter. You don't know anything about the book to bill ratio, whether this is this kind of semi or that kind of. You're damn right I don't. I actually covered semis once upon a time, and it put me to sleep. So I don't do it fundamentally. I covered them. God, it was horrible. The point is this. I mean, we have a downtrend line. We have something that's returned to the downtrend line. In the first instance, when you just get to a downtrend, you bet against it, and then have a frictionless mind. If it's wrong and starts to press through, flip it around.
Yeah. All right, there you go. All right, listen, this one's really interesting because I know that you've been bullish. I know that you made a great call in Meta last year as it was bottoming out, a bullish call here. And, the XLC, so this is an ETF. You don't want to throw up the top holdings here: Meta, Google, Netflix, Disney, and then there's a bunch of like kind of old communication names in there, obviously Verizon, Charter, Comcast, T-Mobile, and AT&T. Talk to us about this and how this caught your eye and what you're thinking about. And is it, obviously, when you look at the construction of an ETF like this, where Meta and Google are, 37, 38% of the weight, is it just making a bet on those, less idiosyncratic on the individual? I'm just curious, like, how you arrive at this, or you don't give a crap when you're looking at Excel.
Here's what it was. So this was from November 30. And the title of the client note was "The Last Shall Be First." And communication sector was the worst performing sector of all 11 sectors from the peak in the market to the trough. And basically, remember, this sector was almost out of business, right? It was just down to T and VZ, to AT&T and Verizon. And so they what did they do? They took a big bunch of tech names and stuck them in there. Google used to be tech, right? And Netflix used to be tech. And Facebook or Meta used to be tech. So they got this thing back on its feet. But basically, tech, we know, bombed out. These names more bombed out than anything. And so it was just a contrarian bet that it was so bad it's good. And
well, throw a chart up while you talk, because it's an interesting chart to take a look at. I mean, this is a pretty clear. I mean, this potentially looks like what the S&P 500 could look like if, in fact, we're on the course to take a look at those August highs. Speak to this.
So look, it could have been a dud. Happily, it's worked out. The question is now what to do, right? And so 60 days later, so far so good. My hunch is to let it go further. And again, it's really a stealth way of playing tech, because everybody knows that you can call Google communications, you can call Meta communications, because we're people Facebooking each other. I don't have Facebook, but whatever that means. Communications is what we're doing now. We're talking. You use a telephone, you send a wire, whatever. It's tech in drag.
God, he had you at tech and drag.
Well, I was thinking that cat from New York, Congressperson Santos. But anyway, I mean, I'm
Santos?
sorry
Well,
about
all
that.
right. So real quickly, Guy, I wanted to hit you on this because, you had a great call on the Netflix off the bottom. And I think you and I were in agreement. And again, we were always going to come back and we're going to say this. You said, listen, I'd continue to be long into that print, but I'd sell it after when it continues to rally. So it's rallied nicely since then. It's at 360. You thought 345, I think is what you said. It's had a 2-day move of nearly 12%. And again, Carter, you frame this really well with the names that you've been right on and they're bullish and they keep running. It's like sometimes just do something. People always ask me, he's like, how do I know when to take a profit? Well, did it reach some of your goals? Did they, did they say the things that you were expecting them to say? Well, at that point, then you should probably do something, right? If that was your target. And you always say, write calls, sell a little, do something. And I really like that. Well, I like that framework. So, Guy, I'm just saying, you talked about Netflix last week. You're right. What do you do this thing now at 360?
Well, it's up 100% now from the lows we saw in the spring. I mean, that's a pretty remarkable move. Obviously, still considerably lower than its all-time highs. Now, 9 months ago, you made a very compelling case for Netflix on valuation, which we did, by the way, and it proved to be correct. We thought we would fill these gaps, which we have. Now you have to ask yourself how much gas is left in the tank. And it's not about Netflix at this point in terms of what I think about the company or Reed Hastings or anything about it. It's about how do you trade the stock from here. And, given the volume we've seen over the last couple of days, I would submit, again, thinking I thought 345 would be it. We've overshot. You have to do something. So if that's selling calls against it, understanding that that does not get you out of your position unless you're called away. So it mitigates some risk, not all. If it's buying put protection, understanding that vol could have blown out at this point and maybe that's not the right course of action. Or if it's selling out of a quarter, third, half of your position or all of your position, all those things are good. Doing nothing here, to Carter's point, though, I think is foolish because what winds up happening is it will move against you and then you're going to be paralyzed by not having done something a week or so earlier.
I got a good one. This is how my day goes. I have an exchange with a portfolio manager, big bank in Europe. They're running about 120 billion. Not that it matters, Carter, because he knows I don't care. But Netflix has 154 billion market cap, and in fiscal year 22, just released, they generated 1 billion of free cash flow, ex stock-based comp. What he's saying, of course, is this is a joke.
Yeah.
He's trying to make a point. Now, he knows that I don't care, and I go, I get it. And I think he said, but then he says, good call on the bottom, and now what do you do? But either way, is that right? 154 billion in market cap, and you generate 1 billion in free cash flow? Sounds expensive to me. But I'm not in the valuation business, right? I'm in the chart business. But either way, expensive fundamentally, or it's come a long way, do something, right?
You know what we're going to do? So tomorrow or Wednesday, we'll do so Guy just said maybe you sell calls, maybe you buy puts in a name like that. You know what we're going to do? We're going to do both. We're going to look at that and we'll do what we call a risk reversal or a collar where you sell an out of the money call versus your long stock and you use the proceeds of that call sale and you buy a put. You have gains up to that short call strike in the stock that you own. You have losses in the stock that you own down to the long put strike. And that's how you would collar your stock here. All right, let's just hit this last thing before we get out of here. We know we're going late. Carter, you thought the Jets were going to find some resistance. It has found some resistance. That $20 level in that ETF that we talked about last week, it's still right in and around where we were. I put my short-term bearish trade using options on. Let's talk about some of these lodging names because I also like that Expedia in the lodging space here. Run us through some of these names here and what you're thinking.
Sure.
Then let's get out of here.
We'll go quick. So Expedia is really bombed out and has all the elements of a turn. So that one appeals to me as a bearish to bullish reversal. But if we look at some of the marquee names, I mean, this is setting up for a breakout. What's not to like? Look at the next one. These are all into formations that I think get resolved, meaning these are stronger businesses than the Jets. Jets has come a long way. These have lagged over the last month and a half, and I think they play catch up. Hilton, we've got Marriott on here. I think we probably got Host. And then here's maybe the last one that's kind of fun. This is a group. You can actually look it up. Right? These are all the stocks in the Russell 3000 hotel and motel sub-industry group, some of which we've just looked at now. Now, if you were to look at a chart of this index, not itself, but relative to the S&P, that's a ratio chart. To my eye, that's go time, breakout.
Guy,
Love
go
that.
time for you, buddy.
Go time. Well, it's go time on a number of it's interesting. I heard Carter say hotel motel. Somebody should really come up with a song that integrates both those words and then mention it a hotel by name, like something like hotel motel
or Hotel California.
Holiday Inn or something. Didn't the Beastie Boys try that, Dan? Wasn't that your jam back in the day, or am I missing something?
I think you're missing something. I like your orange shirt. I hope you're wearing a Syracuse orange shirt underneath
I'm not wearing a Syracuse. Dan bought me a shirt. I got to stand up and display it. It is my
Carver High School.
Yeah.
Of course, Carter, you remember that, right? You remember the White Shadow, the program in the late 70s, early 80s? So Carver High School. I will tell you, Guy, yesterday as I was watching the football, I was wearing my Georgetown Dunks. Those are Nike sneakers, which I never thought in a million years growing up in Syracuse, New York in the 80s, I'd be ever wearing. But I am all in on your Hoyas. My daughter's a freshman there. So you're wearing my Syracuse orange, and I'm wearing your Georgetown Dunks.
We're flying the colors, as they say. Yeah. That's it. Carter Braxton Worth, great. Listen, Carter brings it, and he was bullish in Tesla. He was right. I was not, and I was wrong. That's what makes markets, folks. That's why you listen to everybody. But in the end of the day, you make your own decisions. Listen to everybody. Don't listen to anybody, if that makes sense. That might be the new buzzword for Worth charting. Anywho, that's it for Market Call today. Ranger hockey tonight. Panthers in town. Looking forward to that. Carter will be back on Wednesday. I want to thank our sponsor, FactSet. Financial data and analytics powered by Tomorrow. They're also our data provider. Tomorrow, it's Dan Nathan and yours truly, 1 p.m. Eastern time. We'll see you then.
See ya. Thanks.